Hello, everyone. Welcome to another live webinar with us from Phillip Nova. This is Sri, your facilitator of the day. And what will we be discussing? It is crude oil and beyond the barrel and charting the pulse of the oil market. What will we cover today? We will explore the dynamic landscape of the crude oil market in 2024, from geopolitical shifts to shifting the focus to cleaner energy, and we'll dive into key factors shaping the industry. Expect insightful analysis of supply and demand trends, the impact of geopolitical stress, and the role of the producers' cartel in regulating the flow of global supplies. Gain strategic insights to navigating the uncertainties and make informed decisions in this ever evolving energy sector. Don't miss out on the opportunity to stay wary of technical and fundamental perspectives and evaluate the challenges and opportunities that lie ahead for the crude oil industry in 2024. And who do we have in the studio? We have Priyanka Sakdeva. She's the senior market analyst with Phillip Nova. And earlier in her career, she was a trader with one of the largest financial services firm in India, with more than 10 years of experience running trading and hedging strategies, financial modeling and valuations, as well as institutional sales and risk management. Priyanka is very well versed in identifying trading and investment opportunities and presenting strategies across all financial asset classes. Priyanka frequently shares her macroeconomic views on equity indices, commodities, and forex with the media, which includes technical analysis articles for the Business Times and interviews with Money FM on their Money in the Market segment. Priyanka, if you're all set to go, I will hand the floor over to you.
Thank you so much, Shri, and good evening to all of you online. A very warm welcome to our virtual gathering, our webinar, Beyond the Barrels, focused on one of the world's most crucial commodities, oil. With me, you will be embarking on an exploration of intricate web of factors which are influencing oil markets presently. We will be charting the pulse of oil markets and discuss in details the geopolitical tensions, the market mechanics, the supply demand narrative, and how oil backdrop is impacting global economies and vice versa. But before we move ahead, let me take the liberty to introduce myself. I am Priyanka Sachdeva, Senior Market Analyst with Phillip Nova. So let me just briefly take you to what exactly you can expect from today's session. We will be talking about global supply demand outlook. We'll be discussing the evolving oil market backdrop and basically the fundamentals that are shaping oil pricing right now. We will also discuss what is the influence of current geopolitical stress that's happening across globe. We will talk about the global economic standing and how that has impacted so far and going to impact the oil pricing in coming future. I'll be sharing you my technical perspective on oil, and I will be discussing certain trading strategies that might lure you as an investor. So moving ahead, without further ado, let me introduce you certain key features that are prevalent in current oil market. And basically crude oil is the king of commodities, and that makes oil industry an economic powerhouse in which oil prices are not just monitored by traders but by governments, corporations, business setups. And that's why it is very important in both aspects. It shapes the economic background, whereas the economic background shapes how the future will oil pricing be. The United States, Saudi Arabia, and Russia are the top three oil producers globally, and they nearly produce 1/3 of the global supply. So that makes so the economic standing of these economies and how business is evolving in them actually significantly shape the flow of barrels across international borders. It's widely believed that there is only a handful of Middle Eastern countries that hold the global reserves of oil, and thus energy market fluctuations are highly dependent on the policies that are this OPEC or the cartel of oil producing country brings in. They have a prominence. So supply and demand are basically driven by the economic conditions in these economies, whereas supply basically is driven by the geopolitical tensions and production policies of OPEC or the producing countries, basically. The situation in Gaza is also critical as of now in oil, because how that is going to evolve, or the potential, whether there will be a ceasefire or there will be an escalation and involvement from Iran and US, that will decide how going forward there will be the supply flow across international borders. And thirdly, the Russia and OPEC have committed to extend their voluntary the voluntary restrictions or reductions in cuts in quota till June. So that is already, and that has happened when there is already disruptions in supplies in the key oil producing countries. So that is also going to impact how oil is shaped. And the anticipation of US interest rates. So basically, the incoming data is being widely watched, and the changing narrative of Fed may also shape oil markets. So these are certain important key aspects that as an investor you should track. Now, before we head on to how these impact the prices, let me get you through the oil, how oil production is distributed. So you look at the chart, this is how oil production is distributed. So after looking at this chart, you can see that the top three countries are United States, Russia, and Saudi Arabia. Leading is United States. So that means the change of policies of these countries should be the key movers of oil. But there's a fun fact: the reserves of oil does not relate to the production. It's believed that Saudi Arabia and Russia are the leading reserve holders, whereas United States is the leading producer. The US, which is the largest producer, isn't a significant mover like Saudi. It was earlier believed that way because the US, despite being largest producer, consumes most of its production within its domestic boundaries. Despite of the fact that it produces maximum, the flow is not to the buying nations. It's entirely for its own internal consumption. Whereas Russia and Saudi Arabia, their reserves are better and their production actually flows into the buying uh, countries. So that's why they are more vital. Now, how this is shaped. So basically, how this shapes the supply demand dynamics. So, like any other commodity, obviously, the law of supply and demand should matter in oil also, which means that if there is an supply increase over the demand, the prices should ease. Whereas if the demand side weighs on the supply, or there is a limited supply or disrupted, then the prices should rise. And somehow market mechanics should reach to an equilibrium. But this may not be entirely true for oil. Oil demand is primarily dependent upon how broadly global economies are performing. During the times of downtrend, we usually see a reduced demand from businesses, whereas during the upswing, the demand would be higher. And the supplies also depends not just on the production, it also depends on cost efficiency, technological development, and policies of this producer cartel, that is 22 countries which together form OPEC. So geopolitical stress that is happening in Middle East, and which impacts the flow of supplies through major oil producing regions. And like last year we saw the sanctions that happened on it. So political instability in these areas, they also decide supply. So it's not like a regular commodity. So overall, the intricate interplay between supply demand, the move towards the green energy, geopolitics, they all makes oil a very complex and dynamic market. Now you know what impacts oil. But how? And let's discuss how is current global economic backdrop is transcending the fluctuations into the oil market. In 2024, the global economy stands at a pivotal juncture. Despite ongoing efforts of recovery after post-COVID, I would say, pandemic, economic growth remains uneven across a lot of regions. Some economies or some governments have introduced robust fiscal stimulus measures, which have fueled a rebound in economic activity in many areas, but other economies are still struggling. So I would say because they are struggling, the demand is not fully revived as it should be. Similarly, the supply chains disruptions are already in place. Primarily in 2024, markets discounted that eventually inflation is going to drop. And uh, however, the latest indicators, the US inflation, the CPI reports, PPI reports, and the labor market does not really favor that notion as of now. China, which is the leading consumer, is going through a bumpy recovery. It's the world's largest importer of oil, and there has been mixed data that have been incoming and complicating, uh, even projecting what kind of demand China will have. Some reports say that they are very promising. Some reports kind of create a doubt that there is property sector is ailing and there won't be any stimulus. There is too much expectations which may or may not turn true. OPEC and Reuters and EIA or all basically all oil related reports that have been coming this 2024, they have been robust about the demand, but there is contradictory gap between all these reports. So I would say there is no clarity even because everybody is judging it very differently. Some reports are talking about downturn, some are completely negating the fact that there can be anything called mild recession. So I will not get into discuss this long discussion of what report is saying what because that would probably lead into another webinar. But all I want to say is here that all these reports talk about robust demand and are based on the fact that there is going to be deflation. However, I personally feel that higher rates can stay longer, which would prevail a lot of strength in dollar, and that might just cap any possibility of a surge or a breakout in oil. It's going to keep a lid on oil pricing. And I would personally, as an analyst, would not eliminate the prospect of a mild recession from 2024 as of now. There can be a lot of things that can go wrong. And I think Fed probably knows that. That's why there are different kind of commentaries that come in. They're already pushing the during in the beginning of 2024, rates were supposed to go down by the end of the first quarter, which has already been pushed till June. So what happened next, no one knows. And the surprising fact is that despite all all outlooks fostering demand for oil, OPEC and Russia have extended their voluntary cuts till June. I mean, what? How does markets are supposed to digest this? If this is not bidding for elevated prices, I don't know what it is. So let me take you how oil performed in last 2 years. So if we look at the data from February 2022 to February 2024, despite facing multiple atrocities, oil is on a constant downturn. The last couple of years witnessed phenomenal volatility in oil prices. The Russia invasion of Ukraine threatened oil markets to core in 2022, and we saw oil bouncing above the $100 level. But that intimated Fed and before that, Biden actually released the Strategic Petroleum Reserve, which somehow eased the supply flows. And despite multiple sanctions against Russian crude barrels have been hoarded by friendly buyers like China and India, and they were not actually lost from the global supplies. So they still stayed in the circulation, which kind of eased the soaring prices. So the minute those oil tried to kind of shun away from those soaring prices, OPEC interventions come in, and they have been forwarding these supply cuts that they introduced back in 2022 and 2023. So, and Fed obviously went on to embark raising rates to fight the inflation, which actually boosted the dollar strength. So that also transcended into weakness for oil, because oil is a dollar denominated commodity. Then finally came the pivotal situation in Gaza, which again threatened the flow of oil from the key producing region. In a nutshell, I would say oil industry weathered multiple storms, significant pull and push. But if you look at the graph, oil is still on a broader downtrend. So does this mean that overall investor confidence in oil is shaking? Or do markets anticipate that higher for longer rates will eventually dent demand more than the original forecast? Now, or probably the markets are unwilling to extend any war premium. So I'll be answering all these questions, and we will study how each and every fundamental is shaping oil's price right now, one by one. But overall, oil market has been edging lower because of the focus being on Chinese economy. China was apparently the largest producer. US, who has never been a supplier, has turned into a supplier with this robust production. OPEC maneuvers have been failing. There is rising demand fears, and the global supplies are already restricted. So, if you ask me, these are the 5 points I feel are exerting multiple pressures on oil markets, and I will explain you each and every one by one. So let's talk about overproduction in Western Hemisphere. So if you look at the chart, it clearly depicts that US production over the last 10 years is on a constant rise, and it has even better forecast for 2024 and 2025. So that means it's going to rise. Average monthly, if you talk about the numbers, average monthly crude oil production has reached a record high in December 2023, about 13.3 million. And the latest Energy Information Administration report also points out that it will be growing at a higher pace, at least 13.09 million barrels per day in 2024. So now anybody can ask that, it has been a leader already. So what has changed for market? So I agree that if you look at the pattern of last 10 years, United States has surpassed production of Russia and Saudi Arabia for last 6 years already. But like I told you, they used to consume most of their crude production within domestic boundaries, but now their persistent overproduction, or extra stockpiles that they have been building, is basically extending and buffer for additional supplies that might come to for exports or come to the global supplies. And the fact that Biden administration took a step and released SPR to curtail soaring oil prices back in 2022 has challenged the authority of OPEC. So OPEC's role as a regulator in controlling oil price is currently in a bind because of how US is shaping its production. The next step and the next point is China's staggered growth. Now, China continued to be the source of speculation for oil bears. Like whenever oil starts to spike up a little, concerns about demand from China starts coming in, and the markets have been ignoring the fact that Chinese refineries are rerunning at all-time highs in processing that crude oil that they're sourcing from cheaper oil that they're sourcing from Russia. So even today, the market seems very underwhelmed with the fact that China may reach to its 5% growth. But if you look at the imports of crude oils from China, it has grown multiple times, multiple times. And the fact that the reports from EIA and OPEC contradict their demand forecast based only on China's lack of demand from China is the focus basically in the oil markets right now. There is a, a disagreement between these reports which talk about how China's demand is going to evolve. So that is a key that these reporting agencies have constantly underestimated the demand that can come from China and has been overestimating the supplies despite of the geopolitical tensions. So uh, is this inaccuracy or contrary reports of global oil is starting to catch up with the markets? Is it sending mixed signals? Well, my answer in one line would be yes. It is signaling a lot of doubt. If you look at the next would be OPEC's maneuver. So every time you look at the chart and how many times OPEC has come up with OPEC or Russia or Saudi Arabia, it's basically a group, a cartel of producing nations which has stepped in every time oil tried to make a spike. So every time they come up with some kind of restriction on supplies. I mean, there is already rerouting, there is already geopolitical tensions. uh, then how these OPEC maneuvers justify the voluntary cuts in production? They are definitely, markets have started to talk about their bias towards elevated rates, and it's very justified. OPEC country has got used to higher profit margins, and honestly, who would want to? They've tasted higher gold oil prices, and who would want to shell more oil and deplete their reserves when they can actually make more money by restricting supplies? They're tweaking their supplies, and they are kind of creating a notion of restricting supplies so that the price stays elevated. But as an industry number, if you analyze deeply, OPEC and his allies have, I mean, they're just coming up with announcements, but they are failing to deliver the announced cuts. So the actual cut in production that appears, through the industry numbers is actually smaller. So this is also affecting OPEC's prominence in deciding the global oil pricing. And I personally feel oil market investors are smart enough and they're kind of sidelining or turning a blind eye against what OPEC is doing. So they don't want to put a lot of emphasis on whether they are extending any voluntary cuts or not. Secondly, if you look at the net change, so um, if you look at this chart, the net impact on the global supplies, because there is a jump in US and I would say non-OPEC producing nations, which is shielding the restrictions that OPEC production cuts has begun. So basically, the net impact on the total global supplies is very minimal, and that's why I would say it's stripping the essence. It's a classic mismatch between OPEC's outlook and OPEC's actions. Okay, so next is basically geopolitical crisis that's like we see across the the globe, I would say. The oil industry is a global game, and what happens in the world actually impacts the price of oil, especially because the reserves are very concentrated to politically unstable areas, I would say. There is heightened volatility and there is uncertainty in oil backdrop, which is merely a function of the stress that is going in Gaza Strip. Um, and Russia, Ukraine, obviously the region is the entire region is actually significant to oil critical transportation routes. So a lot of I would say shipping companies have suspended their transit through Red Sea, and they have started taking longer routes. So longer routes actually adds to the freight charges, the fuel is also expensive, so obviously freight charges are more, travel time is more, so your insurance cost goes up. So all of this actually adds to the premium that deliveries or physical markets charge on oil supplies, especially to Asian countries. So all those Asian countries who are actually dependent on Middle East for their oil requirements are actually suffering. Secondly, the ceasefire talks are like not coming to any resolution. They are like being dragged every day. They are making headlines, and they were initially a time when there was discussion of sanctions, removal of sanctions on Iranian oil, which also didn't materialize. So everywhere, I think it's all about creating a news, but not really uh, reaching a conclusion. So the risk if Iran gets involved into Gaza's current crisis, and then US also jumps into it, is actually keeping a lot of momentum in or adding a war premium. But all of these sanctions on Russia or Iran, neither Israel, Hamas, nor Russia or Ukraine, not they have given oil short-term spikes, but they have not left with a boosting impact on the pricing, to be very honest. So does that mean that oil markets are turning blind eye to war premium? So yeah, that's a very natural question to ask, but I will answer it only in one statement. Last evening, there was a report of Russian refinery on fire because of drone attacks, right? That left markets with a 3% hike in oil price. I mean, just one refinery on oil. So there is definitely uncertainty, and oil markets are scared to the core. So there is a war premium in the prices. So just imagine if that war premium somehow goes, what will happen to the oil pricing? So it is there, it is being built up, the pressures are there, and investors should watch out. Last but not the least is Fed's monetary stance. Oil is a dollar denominated commodity and thus holds a very complex relationship with Fed stance. Back in 2022, there was a magnanimous surge in oil, and it was basically a vicious circle because of oil. Inflationary pressures came in, inflation came in, and then Fed embarked on monetary tightening. That impacted the strength of dollar, which weighed on all oil prices, and eventually those soaring prices come in control. Now, I would say that markets. Now, I want to tell you that current demand side narrative of oil is entirely dependent on the fact that market is estimating a soft landing. But I just want to share you the last 6 cycles of Fed last rate hikes and the recession that followed. Out of 6 times, 5 times recessions did followed, and it took about 12 to 18 months to have that impact. So is it fair enough that we analysts have stopped, kind of including a possibility of recession? Well, I don't think so. I am not one of those analysts who still, I would personally feel that there is a chance and there can be a bullish or a bearish or a probability of something breaking. So there is a probability that there can be a ceasefire, there will be significant drawdown in US inventories, and China also suddenly starts giving us a lot of demand, so there, that will be very bullish for all. Whereas if there is a bearish global outlook with escalation in Gaza or massive build in US inventories or higher Fed rates, that's going to be a problem for the demand side of the oil. Possibility of soft landing, I would say, is only 20%. So if you ask me and I have to give you a one single point down, I would say the most plausible outcome is a mild recession. And with that, I would say my forecast for oil will be that it's going to be range bound. There are multiple pressures which will keep oil suppressed, I would say. And however, the geopolitical tensions and OPEC's taste or a priority to have elevated prices will ensure that there is enough traction at the lower levels of prices. So if you, I will say that according to me, the oil would be in a broader range of $90 to 70. Brent may be hovering around 90 if there is certain escalation in Gaza, and uh, and Biden administration will come running to fill up their SPR reserves if it does touch down to $70. So all of these will actually force oil to be in a strict range bound. We are not going to see any major spark on both the ends, especially because I would say it's a crucial year for three major economies of the world, like US, India, and China. Both India and US face elections this year, and whether we believe it or not, political parties reigning and looking for re-election does not want oil prices to go up. They don't want um, their what do you call the people, the general public, to be offended or have inflationary pressures. And China is striving for growth already. So for them also, they don't want oil prices to go up. Their refineries, their business, everything depends on oil. So the government of all these three major economies will try and keep prices lower. Having said that, that means politics are the only thing that will be keeping lid on oil. Well, no, actually, there is a culmination of everything. It's a critical year, election year. There is rising US stockpiles. I mean, just leaves aside the last week because it showed a little slump. But previous to that, 6 weeks, there is stockpiling happening in US. And Fed rates, I don't think is going to come down that easy. So obviously there will be strength of USD that will also exert pressure on oil prices. All projections say that eventually, like the first half at least, will have more supplies will be higher than demand. However, demand might just pick up at the end of the year, which we are still awaiting to actually see whether that happens or not. So there is pressures and uncertainty around the dented global growth, and all of these factors actually will keep price of oil range bound. uh, Moving ahead, I will say that I want to conclude is that oil markets may be in denial, and yes, 2024 will be a very tough year for oil. It seems prices will remain relatively stable with only slight improvements and declines, and unless and until there are any significant events like um, something that pushes markets to add a lot of war premium, or there is Chinese outlook which suddenly takes a turn. So unless that kind of event comes in, the overall outlook remains cautiously optimistic, and we are still waiting for any bullish indicators in oil technically also. Now, I have been talking and talking and talking about fundamentals. So, as an investor, I understand it's important to have a view of the fundamentals and how they are shaping, but how you have to apply it on trading oil is equally important to learn. So, let me take you to certain strategies that you can use these fundamentals to actually derive and trade. So these are the three different types: cues from inversely related assets, there are speculative strategies, and there are technical indicators. So I'll discuss one by one. Let me take you through inversely related product. I'm taking here a US dollar, and this is an historic chart which shows that oil and US dollar has an inverse relation, which is very obvious because it's a dollar dominated commodity. So if you have an outlook on USD, you can take a counter position or plan a counter strategy on oil and make money out of it. A simple tip here for the investors would be that eventually this year, I don't know the timeline, but eventually Fed will start easing dollar. And when that happens, it will drop against the basket of currencies, and at least it will give oil a short boost for some time, a short term outlook. So that is the time when you can go long on oil. Simple. The next would be basic speculation. Now, this is a recent chart that I've taken, and I've taken the moving averages also. It's basically a WTI chart on daily basis. Now, this has been confined to a, a triangular wedge. It's like, and it has been consolidating. So I've joined the tops and lowers and bottoms. So if you see there, the most probable outlook of oil right now, at least for the first half of the year, will be consolidation within this range. So you can have a view on oil and you can simply take a position according to the speculative strategies that you want to make simple. Then comes the using technicals. Here I have taken a Brent chart. Okay, this is a long, like a last 2 years, 3 years chart. So I have, if you look at the blue line, I've joined the tops of the oil, right? So if you look at this, that gives you a downfall. So that means every high here is lower. So investors, when you look at this kind of a graph, investors are advised to enter into a sell on rise strategy. So every time it does come near the line, you actually enter into a short position, and you can very well do that using any of the future products, right? Now I want to take it further, and this is not the only thing as an investor that you have to watch. Okay, so this is the same chart, that blue line is same, and I've just consolidated into the what's happening currently, or in the recent few months. Now oil, if you look at the orange line that's sloping upwards, I've joined the low. So yes, it's on, on a decreasing platform, so you are selling on a rise. But if you look at the lows, now after joining the lows, it's been higher. That means it's not very bearish also. When you have lower lows, again it gives you a strategy on buying at the low, and that's what exactly has been happening in oil. There was a lot of buy positions on the lower levels, and there was a lot of short positions on the upper levels. So if you look at these, um, Brent, uh, like Brent will be here consolidating, and if there is a breakout from this triangle formation, the movement will be at least $5 on both the sides. I will also take you a little more further and in detail. So if I take you to what's happening in the last 2 months, if you look at this upward sloping wedge between the green and the orange line, I've joined the higher lows and higher highs. So oil currently is between this wedge, and as an investor, every time it comes near to any of the green or the orange line, you can take a short or a long position. But look at these three bottoms, similar bottom that oil just made in the last month. This has actually started me to double guess my strategy. So I would say that this level becomes now the bottom for oil. So earlier when I was saying that yes, it's a broader range of 10 to $15, this triple bottom here has actually changed that narrative. It's going to support oil, and I would suspect that oil might just go to this dashed green line, which is like 87.70, somewhere here between where both of these lines are intersecting. And if there is a breakout above this line, again, it will be like at least 20% here and 20%. If this yellow line, if it falls below this one, again 20%. So as long as it's between this, so what happened yesterday was there was a lot of short here, right? So last night's news actually pumped people. A lot of stop losses must have been triggered, and now it's on a high edge because that short capacity or short open positions became a lot. So all these technical indicators can be used to see where you want to enter as a long, or where you want to enter as a short position. So I personally feel it should just come here within this range and then take a break on either side. So this takes me to the end of the webinar and the bottom line that I would like to share with you all. There has been a lot of inaccurate reports in global oil supply and demand, which are starting to catch up the nerves of markets. So something will break. The demand outlook still stays positive because as of now, people are assuming that there is nothing wrong with the foundation and eventually economies will survive. Geopoliticals and war premiums will extend substantial oil support. So obviously around those levels of 70, 75, oil will always crop up higher. Whereas higher rates can stay longer and thus we can see a lot of consolidation in that broad wedge that I just shared. And a change can come if China does beat that 5% growth and there is enough promised stimulus as authorities. It's a perfect recipe of volatility, and that's what investors should gear up for in 2024. Thank you so much. And if there are any questions, I will be very happy to answer them.
All right, members of the audience, you heard from our analyst herself as she gave an overview of the crude oil market. This is your chance to ask questions and let her give her insights on those questions, and hopefully it helps you with your trading. While we wait for some questions to arrive, Priyanka, what would be your key takeaways from today's session?
See, I personally feel that there is too much pressure on both the sides, and I am not convinced with a lot of reports that are being circulated in markets for oil. I mean, it's like I personally feel there is too much headliners, but the resulting impact on oil is not that great, right? So I think investors should go on the facts instead of headline news. And of course, the uncertainty will stay because of the geopolitical crisis that's going on. And unless and until we have clarity on Fed rates and China's growth, I think it will be a trouble for investors to actually pick up a side for oil.
Hey Priyanka, as an oil analyst, what would you recommend as the ideal resources that investors should look at, or maybe key market events that investors should look at if they are closely monitoring the crude oil market?
See, like I'm telling you, so there is generally people will resort to OPEC outlook or resort to EIA outlook. But recently, I feel that IEA especially has restrained itself from talking about the actual numbers instead of they're just marketing the green lobby for oil. I mean, I will not trust that report anymore. So, and OPEC reports are highly biased towards keeping elevated rates up. So I would personally say that you have to understand that what they say in reports and what the numbers actually mean can be a little different. So obviously, as an industry analyst, also for me, also these reports are the source of the numbers. But I would stick to numbers instead of what's the message the report is saying.
Based on how the geopolitical landscape is panning out, are there major key events or things that could happen in the near term? I know this is a year we have a whole lot of elections coming up this year.
Yeah.
I mean, elections have happened and are coming up. Are there any other events that you think investors should
No,
keep a
I
close eye
hope
on?
Yeah, I hope elections will go smoothly for all promising economies. And like I just shared, I am not very pro of a soft landing. I feel that there can be a mild recession, and that will change the narrative for oil. So that's something all industry players should watch out for.
Okay, members of the audience, I understand we don't have many questions today. Let me just share my slide. I have something to share with you that you might be very interested in if you're closely monitoring the crude oil market. Let me just swap screens right now. All right, if you're monitoring and closely trading the crude oil market, you can trade the crude oil futures, the WTI crude oil futures at only 98 cents. Find out more about our current promotion by scanning the QR code here. This is a micro WTI crude oil contract. It's very affordable at just 98 cents. All right, so that's the first announcement which I have for you. The second one is we have more learning opportunities coming up. Pardon the webinar at the top. This is a seminar. We have a seminar coming up on 21st March that features professional trader Bini Ong. She's going to provide the insights and opportunities for second quarter 2024, and she will discuss the global market outlook and opportunities that you should keep a close eye on. All right, so you can scan the QR code there to learn more about this event and register as well. Okay, so flipping back to the crude oil contract, since this is a crude oil webinar, and you might be keen to see how you can take away those actions and recommendations from Priyanka and apply them to your trading. So this is a contract you might want to keep a close eye on. All right, we don't have questions at the moment. Rest assured, you can still ask us questions post webinar. There will be a survey form at the end. You have any other questions which comes to you after the webinar, you can type your questions in there. We'll be very, very happy to address them. We have lots more learning opportunities coming up as well. So we will send you details of upcoming webinars in our follow-up email tomorrow. So do look out for it. And once again, thank you so much to the lovely Priyanka for taking the time to give us an overview on the insights on the crude oil market. Is there anything else you'd like to say to our audience?
No, thank you so much for hearing. Just keep pouring in any questions or any information you need. You can just leave the message for the sales staff also if you want to open an account or basically want to have more information on what contracts we offer to or what other products you can trade. So just feel free to leave in answers. We'll answer every one of them.
Yes, that's exactly what we will do. If you are frequently on social media, why not take the opportunity to learn about the markets as well? Follow us on social media. We are on all your major social media platforms, be it TikTok, Facebook, Instagram, and YouTube. We have lots of webinar videos on YouTube, so you can revise past content. So take the time to follow us on social media and stay abreast of the markets and be updated of upcoming opportunities. Once again, thank you so much for being a wonderful audience. Till our next webinar and seminar, take care and all the very best with your trading. Good night.